Hello everyone, welcome to the Analyst Classroom. Today we are going to learn about the non-current liabilities, also called as long-term liabilities. So basically there are three types of long-term liabilities. First is the bond liabilities, second leases, and then pensions. So if we divide the bond, there would be the three types of bond: discount bond, par bond, and premium. And similarly there are two types of leases: short-term leases and long-term lease. And pension is the two types: defined contribution plan and the defined benefit plan. So leases is basically the rent agreement. Before understanding the leases, we need to understand the amortization schedule or table of the loan. So here the loan amount is the 1 lakh for equal installment. Interest rate is 10% per annum. So my installments comes the 31547, and here is the amortization table you would get from the bank or issuance authority from where you take your loan. So interest would be 10,000 on the first year opening loan into multiply by the interest rate 100, 1 lakh into 10%. Principal repayment is installment minus interest rate is principal repayment, and closing will be loan amount minus opening minus installment. Closing in 747. So this then opening loan 78 into 10%, 784545, and installment minus this is equal to principal repayment and closing. This is the understanding of the amortization schedule. You could directly get in this taxes calculator also. So just enter clear second clear TBM and enter the present value of 1 lakh. 4 is N, IY is 10, payment is 31547 in the minus, and compute a 7 and a second and amount, and then you will get the option of entering P1 and P2. So if you want to check the year 3 data or year 1 data, just enter P1 as a 3 and P2 is also 3. P1 P3. What is the P1 and P3? If you enter the P1 in P2 as a 3, you will get the year 3 data for the interest and principal in the below. And if you enter the P1 is equal to 1 and P2 is equal to 3, means you will get the total of the year 1 to year 3 data for the interest and principal, because it's to sum the all the 1 to 3 years of the data. And if you enter the P1 as a 3 and P2 as a 2, you will get the error because you are saying the calculator to start from the 3 and end to the 2. That's not possible. You need to start from the 1 to 3. Then we come with the lease. Lease means, in simple terms, lease is a rent agreement. What type of rent agreement? There is a lease, there is a leaser. You both agrees that I will pay every year 1 lakh rupees of 10 lakh 1 lakh rupees. In return of, I would get the right of use to use the 20th floor of the office of your building. Okay, so that is a lease agreement. In IFRS, there are two types of lease: long-term lease and short-term lease. In US GAAP, there is a long-term lease and short-term lease, and then there is two types of lease in the long-term lease also: operating lease and the finance lease. Finance lease is also called as capital lease, and the finance lease of the US GAAP and long-term lease of the IFRS are both same. Okay, so in short-term lease, no rent expense shown as the rent expense, no asset is created, no liability is created. And short-term lease and long-term lease is defined by its amount, not by its time, and the amount is around $5,000 immaterial. If the lease amount is immaterial, you would consider that lease as a short-term lease. You don't need to create any asset or liability for that lease. How would I identify if it is a finance lease or a operating lease in the US GAAP? How would you under operating lease and finance lease? So finance lease has these below conditions. In the agreement, there would be a title transfer. Second is the base tenure is substantial part of the asset life. For example, more than 75% of the asset of the life. There would be a bargain purchase. Then PV of the lease amount is substantial part of the value of the asset. Present value of the lease amount is the substantial part of the value of the asset. And the fifth is the customized for the leasing. If the asset is customized for the leasing, then there would be a finance lease. Then let's understand the IFRS plus US GAAP finance lease. So what is the transaction look like? There is a leasee and a lessor. Leasee pays rent to the lessor, and lessor gives the right to use of the asset to the leasee. But how accounting standard perceive this is, there is a leasee and lessor. Leasee is purchasing the asset from the lessor by taking the loan from the lessor. Taking the loan from the lessor. So how it would be reflected in the balance sheet is, you need to show or create the liability and the asset both for your lease asset. So asset and liability would be the present value of the all lease payment. For example, 1 lakh rupees in the above example. An asset would be depreciated of the life of the asset, and liabilities also repaid based on the amortization table. So mm, this is the first example, amortization example we discussed earlier. So this is the principal repayment and closing loan and all the amortization table. You could use this for the lease amortization also. So what would be the balance sheet impact? So lease liability times 0 would both would be the 10 lakh. In the T1, liability will be this closing 78453, and my ROU asset would be depreciated flat. For example, 25% on the asset in the 4 year. So liability would be this closing load 5475 and 25% flat on the asset depreciation in the T4 0. In the income statement, you would show the 25% appreciation of the asset and interest expenses at 10 7,84554. These interest expense in the non-operating expense, and depreciation would be 25% flat. And in the cash flow, interest paid goes to the CFO. In the US GAAP, IFRS gives you the freedom to showing the CFO or CFF. Principal repaid will be the CFF. Okay, so this is the impact of the lease payment. Then comes the US GAAP operating lease. Same on the balance sheet as IFRS and US GAAP. Operating lease is the same. You need to show the asset and liability both, but income statement will show the single line item as a lease expenditure. Here, income statement will bifurcate depreciation, interest, two line items. Here, you will show only one line item as a lease expenditure, and you will there would be a straight line amortization of the expense 31, for example 31547, and cash flow statement would be CF. Then comes the pension. There are two types of pension: defined contribution plan and defined benefit plan. Defined contribution plan is easy. There is no asset created, there is no liability created, and contribution expenses expense out. Simple. So contribution is simple. In the defined benefit plan, there is a liability created as a pension benefit obligation. Asset is created as a plan asset and subject to multiple assumption. US GAAP and IFRS net amount reported in the balance sheet. So if I want to simplify the defined contribution plan in this means in this plan the employer promised to contribute a fixed amount, say 10% of the salary, to the employees retirement account. What employees gets at the retirement depend on the how well the investment performs. The risk is on the employee. He just invest and gives at the retirement. Uh, it depends on the how well the investments performs. For example, company says, hey, we will give you 5,000 every month in your pension account. After that, it's your job to grow it. Okay, and just give the agreed amount to his pension plan. So company records only the amount it has contributed to during the years. No long-term liabilities created. Treated as an expense is the profit or loss expense. Okay, and in the defined benefit plan, in this plan, the employer promise a fixed pension after retirements like 20,000 per month, regardless of the investment performance. The risk is on the company. The risk is on the company because they must pay that fixed amount no matter what. For example, company says, don't worry, we will pay you 20,000 monthly after the retirement no matter what's happened. The balance sheet impact would be the company needs to establish and record a liability for future pension payments. Actuarial calculation are used to figure out how much the company owes in the future. Okay, so there would be created the pension benefit obligation and the plan assets, how much is contributed and how much it will need to pay. So if you there would be a report of if the pension benefit of PBO is 100 and plan asset is 120. Asset is reported as the 20, and if PBO is 100 and plan asset is 70, PBO is reported at 30 only. One thing is reported. Difference between the two. So the formula to calculate the closing PBO: opening PBO plus service cost. Service cost is means additional to the liabilities because employee work for one more year. They need to pay one more year pension to the employees, so it will be added. Interest expense, time value of the money. Post service cost, plan amendment, change in the pension formula. Any changes will be added. Changes in the actuarial assumptions will be added or subtracted, or in and minus benefit paid. What the paid is subtracted from them, and you will get the closing PBO. How it's stated: service service cost. Service cost is expense in the P&L. And past service cost result of the any plan amendment also will be expense out. Remeasurement of the PBA. Remeasurement will be actual gain and loss is recognized as OCI, not amortized in P&L. Difference between the expense and actual cost. Okay, recognized in OCI. If plan is overfunded, then the net interest income would report at the net interest income. If underfunded, then the net interest expense. Pension amount is netted in the P&L. All things reflect in the P&L. In the US GAAP, and here discount rate is equal to expense return, and here discount rate and expend, expenditure return is different. In the US GAAP, is service cost is shown in the P&L, but past service cost, any result of the amendment would go in the OCR. Here both goes in the P&L. Remeasurement recognized in P&L or OCI, then amortized to P&L using the corridor method. Here no amortization in the P&L. Here amortization in the P&L. And net interest expense reports separately, and expected not actual income is reported separately and amortized over remaining service life. That's it. This is the basic understanding of these all the long-term liabilities. Thank you for listening. Have a good day.